Peter Bell, April 18th, 2020. Notes on Taiga Gold Corp and SSR mining. I've made some comments recently about whether SSR mining might decide they don't want to wait to proceed all the way through the property option for Fisher and just buy Taiga outright. And it's a pretty academic consideration at this point because the shareholder base from Taiga is probably pretty sticky, and it may look like there's a $7 million valuation on the company right now, but would management sell it for that today? No. Would they sell it for 10? Would they sell it for 20? Would they sell it for 50? Would they sell it for 100? There's a whole bunch of questions you can ask, and you can do some calculations to compare what SSR mining has under the option versus those different prices to give them a sense for when they may jump the gun and buy the company outright. Key point being that SSR faces a $300,000 payment in October this year to get their 60% earn-in, and then from there they have a year to pay $3 million for another 20% to get 80%. So the question is, what is that remaining 80%, remaining 20% of the Fisher project worth to SSR mining? And is it reasonable to think that they might buy Taiga to get that 20%? Why wouldn't Taiga sell them that 20% interest for whatever price? Or why wouldn't somebody else buy it? Or why wouldn't Taiga maintain that 20% by matching the ongoing expenditures under the JV? Lots of different ways it could go, but the thing that interests me is the possibility of the market to be inefficient or slow to price Taiga, and slower than SSR, right? So the potential for SSR mining to say there's substantially more value in Taiga than whatever the market price is, and probably so much more that we can pay a substantial junior mining takeover premium for Taiga and still benefit. Lots of important thoughts there to unpack, but it's not really the point that I wanted to make with this recording. The thing I wanted to talk about here was specifically the developability of the MAC zone at the Fisher project, and how the Fisher project and Leland or Orchid might fit into the SSR plans for the CV complex. Do they want to double the scale of mining there. One of the big things to consider is that they're using the old milling facilities that Claude Resources built at CB, and they're actually ramping underground from the CB underground workings to the Santoy. I believe it's 10 kilometers. I think it's another 10 or 15, maybe even 20 kilometers from Santoy to Fisher. So, what does a development plan for the Mac Zone look like? Say SSR gets the message about the gold price stimulating increased production and starts looking at a plan to double production at the CB complex. How do they do that? Short answer, lots more mining. Long answer, where's the new mill go? In passing, I've heard comments from Chuck Downey in an interview I published that the CB camp is a little tight. It's on the edge of a lake and there's a landing strip. So it raises the question, if you're going to add new infrastructure up there, where would you put it? And it may be that the large land package that is Fisher, I think it's like, I want to say 200 square kilometers? 20,000 hectares or something like this? I think it's quite large. Not only does it host potential for, multiple ore bodies, it may yield new solutions in terms of mining infrastructure. There's a big power line that feeds the CB mill, and it could have you could tie into that for development somewhere in Fisher. So what does that look like from a logistics perspective? Is there a nice spot for an airstrip somewhere around Fisher? Is there, again, good laydown yards? Is it going to be a satellite mining scenario? Or is it a standalone? How does it relate to CB? What kind of mining method and mine plan would they have at Fisher anyways? Ramp down 20 kilometers from Santoy? It sounds like a long ways, but it avoids all the lakes. And it keeps you at the particular elevation that you want to be, so you don't have to worry about building a shaft or a ramp down at the new mine site. There's a lot of questions that are pretty tough to put good answers on yet, but we can start to map out the SSR mining reaction function, right? So they did a bunch of drilling in January and February 2020. Results are pending, and we can start to talk about, last season they hit their first ore grade. These greenstone gold belts are pretty well defined spatially, And high grade can be pretty concentrated when you're into it. So, are they into it? We'll see soon enough. And then the real drive here is the question: what types of results would yield what types of responses from SSR? How many, what kind of a volume with what kind of grade is going to trigger them to immediately start planning and permitting a new mining setup at Fisher. If it's twice as good as Santoy in grade and size, would that be enough to trigger SSR to accelerate development timeline for Fisher? Are there any results right now at this early stage that could be good enough? Or is it too early stage for SSRM to get excited about making a big step like that? I don't know. But trying to guess at that seems to be absolutely key for the odds on what might happen at that mining camp, which is really everything to, the success of Taiga. Is there potential for Taiga to go from 10 million market cap to 100 million market cap just based on SSR doing things and some more greenfields exploration results at Leland? Would that do it? ...2020, right? There's talk that this could be a pivotal year. It's easy to say that. Everybody wants to believe that. When you're investing in high-risk situations like this, you want to know that there's big upside. So, what does that look like specifically, right? What does it look like if they started to build at Fisher with the planned, initial production 2025 of another 100,000 ounces? Could they do it? Whew. If they did, what's that 20% worth that Taiga has? There's a lot of questions to that, because that 20% brings along a big spending obligation, a 20% spending match on whatever development spending might happen. So if they're going to build a new underground high-grade gold mine, what is it, 100 million? 200 million in spending? I hope it's not more than that. But Taiga's on the hook for 20, 40 million? How does a company with a 6 million market cap afford to match those payments? The answer is, well, it's 20 million over 5 years. It's $4 million a year. And again, how does a company with a $6 million market cap, $7 million market cap make a $4 million spending match? And the answer is they don't. Something would have to change if we were there. If Taiga was still there where it was, it probably would just accept the dilution or sell the 20% block because they wouldn't be able to afford it themselves. But there's that classic wrinkle in the terms of the deal where Taiga gets $3 million from SSR when they go to 80%. So if SSR came out of the gate, screaming out of the gate on taking 80% and said, yep, we want to put this in production 3 years, 5 years, it's going to entail a lot of spending, and Taiga would at least be able to keep up with first $3 million, presumably, from that new cash, which would be matching $12 million of spending by SSR. So a total of $15 million in project spending. Taiga would have the cash from that exercise to match that, which is some lasting power. And $15 million into an accelerated development program with what is arguably the best mid-tier gold producer on the planet. It's a nice position to be in for a junior. And at that point, you have to wonder, what's the access to capital for Taiga? What's the valuation? Right? You'd hope Taiga's at a $25 or $30 million valuation. They can, do a 10% dilution round, 20%, raise $3 or $5 million bucks. Keep in mind, all this spending is in Canadian dollars, so we're not getting chewed up by the US dollar conversion rate, which is helpful. So what, right? Yeah, well, maybe one thing to mention is this kind of classic idea in junior mining that there's risk all around, and yet this tiny junior has a lot going for it. And the biggest risks are probably self-inflicted, right? It's this classic Rick Rule stuff. Biggest enemy is to the right of your left ear, the left of your right ear. Silly to say it, but it's true for investors, and I think it's true for management too. You look at the various scenarios that could play out, and Taiga's not really under the thumb of SSR in any of them. And so it's up to Taiga to maintain that position of self-reliance, right? Avoid excessive dilution, avoid desperation, which isn't a very compelling sales point for a junior mining stock that's supposed to go 100 to 1 to survive. Really, that's it? Well, sometimes, when you have a partner spending X million dollars, it's kind of like, yeah, that is the most important thing you can do. And tied in with that is, don't weaken your position excessively. So don't stake some ground in Ontario and go to work. Just stay focused. But, don't be afraid to do what you do best. Don't be afraid to do what got you in the position that you're in the first place. And for Taiga, that's staking good ground and being in the right place at the right time. Really, they got the option on Fisher without having done any field work. They were just Johnny on the spot staking the ground. And then when SSR bought Claude, they said, why didn't anybody stake this? We need this ground too. This is clearly the geology's continuing here. So it's probably an oversight on Claude's part way back, but an opportunity for Taiga when the online staking started in Saskatchewan. Kudos to Taiga for being smart. It's a credit due to the mothership, Eagle Plains, and all the people who understand the junior mining business involved there. So, again, the biggest risk might be management when it comes to Taiga, losing the thread in some way. And the hedge on that risk is management. Again, so it's not the best way to say it maybe, but it's fairly clear, because this group again has some pretty unique experience, arguably one of the better prospect generator pubco groups of all time. Certainly one of the longest lasting, most resilient, and had some big wins with Spincos before. So is this another one of those? Could be. Good news is management's been down this road before. They have a sense of what the experience can be like. And the unusual patience, I think, must be involved in waiting and watching a major miner or mid-tier miner do something, right? The timelines on real gold mining operations are very different than the timelines on exploration seasons or junior mining stock trading. So again, to look at these strengths and weaknesses milling around, and then to think about valuation, and to think, when does Taiga get expensive? Is $100 million number on Taiga expensive? They've ended some ground to, probably for most people, they've ended some ground. Somebody had an option and they got a bunch of greenfields exploration stuff. Why would that justify $100 million? And then turn over the coin and say, okay, SSR Mining's talking about, 100,000 ounce production scenario on a 5-year accelerated timeline in Canada and Saskatchewan. They're doubling the capacity at the CB complex with a new mill and mining infrastructure on ground that Taiga owns 20%. At that point, $100 million valuation would almost be a question of, can they afford to match the ongoing project spending and keep their 20%, or do they risk getting diluted down? Which is to say, is the company too cheap? What's 20% of 100,000 ounces? You know, 3 to 5 years, starting 3 to 5 years from now. Canadian gold price, call it 2,400. Say the all-in costs 1,200. You know, 50% margin, generous. 100,000 ounces, $1,200 margin, $1,200 per ounce margin times 100,000 ounces. You know, it's $120 million of profit a year on the project level, and Taiga has 20% of that. So you're talking about a 20% profit stream, where SSR is the operator, one of the highest quality operators in the world. You know, what's my life? 10 years? 10 years, 24 million a year, 240 million total profit, you know, cash flow undiscounted. Whew. Yeah. You know, maybe it's an $80 million NPV and 100 million sounds like a premium to that, but that's probably not unrealistic for the market to give it some premium in a buoyant, you know, gold market, because there's the optionality of all the other discoveries on this 20% and potential to extend mine life beyond whatever's defined in the resources, which are notoriously fickle with these high-grade deposits. As the SSR guys have said, you know, we can get stuff into inferred, but to really get it into measured, we got to be underground, doing drilling underground. So some people understand that, some people might discount that on the street, but again, assuming a buoyant market, that's a pretty big win. It's a 10-bagger from $10 million valuation, which is 50% up from where we are. So it's, you know, there's the potential for 20 times, not 100 times, but more than 10 from the 5 where it started, assuming no dilution. And, you know, could Taiga go to 100 million market cap on no dilution? Well, they just raised $1 million plus 1.5 million. They got a lot of cash apparently, and they're going to be receiving some cash in October, 300,000 property option payment, and then there's another 3 million cash coming if and when SSR decides to go to 80% on the project. They have 1 year after October to do that. So kind of worst case scenario, Taiga only gets the 300K, and then next year, October 2021, they get 3 million from SSR. It's a bit of a long wait. It's a bit of a long wait. It really is. But, you know, given their current cash balance, they could get there. The question is, what will they do this summer, right? If they went off and did a bunch of drilling work, they wouldn't be able to last that long. But if they do a bunch of, you know, greenfields prospecting work, which is what they do, then yeah, they probably will be able to last that long with a fairly healthy cash balance. Keep in mind, again, this is a group that knows how to operate simply and cheaply and effectively. So talk of October 2021 where Taiga gets a $3 million check from SSR and the company's sporting a $30 million valuation on its way to 100 million 18 months later. At that point, 18 months after receiving the 3 million, all that money's likely gone, and they likely would have had to dilute by then. So unless market really got ahead of itself and excited off of, ultra high grade drilling by SSR at Fisher, and more high grade grabs at Leland and Orchid, if that was, it would be hard to get to 100 million without some dilution, which is fine, because 100 million is a big valuation for a junior. And the risk is generally skewed to the downside at that point, because you got to produce some really hot results to get up there and to stay there. So include some dilution, and right, your 10 bagger, your 20 bagger goes down from to 8 times or 12 times up. Still big returns, big wins. Double, going up 8 times is the same as doubling, and doubling again. That's an unusual outcome, but it happens. And sometimes it happens slowly with a trend, sometimes it happens really quickly. Given that Taiga's a junior, I typically expect it to happen quickly. But, given the conversation I'm having here around long-term development plans for an underground gold mine, it makes me think things happen slower. But, again, it's junior mining, and market, if it's going to come around to believe in something, that happens fast. Months, weeks to months. It's a process that takes place over years, but the big moves happen over months. And then it's the question of, okay, well, what are the catalysts of those big moves? And it's probably shocking grade headlines. Really, in one way or another, it's surprisingly good information. And what could be surprisingly good at Fisher? That is the question. And to get an answer to that, you probably have to do a pretty detailed study of the Santoy ore body, old CB ore body, and then to double it or whatever and say, what does unusually good look like in comparison to this thing that they mined, they're mining right now, right? And that's a super valuable exercise. So pretty simple. Talk about grades and widths, although there's a lot of subtlety around the orientation of these gold veins, and what you hit in initial surface, drilling from surface, may be really far off from true width, and may be hard to understand the geometry. So it's a little hard and potentially risky to give yourself hurdles on what a 2x would look like on Santoy from this January drilling. Really. But all of that, opacity or lack of certainty in this information is what makes it all the more important to study so carefully and in creative ways, right? It's really important to be creative in how you think about this data, because your competition is thinking about it in pretty linear ways. And again, you go back to these Eric Sprott 2017 speech. He's talking about conservatism, and you're dealing with a geologist who doesn't want to waste money sometimes, or a broker who doesn't want to buy another stock that's going to go down or whatever, right? There's always lots of reasons to say no. It's important to have some sense of realism. And the reality is, it's entirely possible to find an ore body that's twice as good as Santoy along the same shear structure, 10 kilometers away, 20 clicks away. Just based on the statistical distribution of, the features of these gold deposits, it's entirely reasonable to talk about finding something that's twice as good. But the question is, what does twice as good look like? And I think mainly it's going to be grade. I don't think it's a case of, we found something and it's a lot shallower. I don't think that's it. Based on, again, what Chuck Downey was saying about how these guys drill deeper than the Eagle Plains guys would have at Fisher. Again, you go to that Eric Sprott thing, you hear saying about why particular elevations can be really fertile for gold. So I don't think that it's a case of, it's been shifted up and it's closer and it's easier to mine or anything like that. No, I don't think that's really it. And I don't think bigger is necessarily the key here either, because these deposits are kind of hard to define and delineate generally. So it's, metallurgy, right? You look at the numbers of SSR on there. Santoy recoveries, it's in plus 95. It's like 98, 99. Unbelievable. So they've got it dialed. I think it's got to be great, right? So I don't know how do we even describe that, right? Is it just average grade that you want to look at? Or do you really want to start by looking at the tails and saying, look, the highest grade intercepts over whatever small interval, half a meter, that we see at Santoy, that's this grade. And we've got 2 times that, or 3 times that at Fisher, at Max Zone. Right? So that's going to be surprising. Those would be surprising headline results. And it's a case of, if they can report that, then that shocks everybody involved. It's not my default scenario that I'm expecting, but it's certainly one that I want to conceive of, prepare for mentally in terms of, how good could it get? Because I don't want to be having a situation, where the stock doubles, but it's actually twice as cheap as it was before, because the information that came was just so good. So again, what would that information that was just so good look like? The answer is probably just some really gory high grade. And you know, more of it or richer, more concentrated or richer than what they see at CB or Santoy. That's really the thing for me that I'm going to be looking for as something that's obvious, you know, something that anybody can kind of figure out as a useful comparable. And something that's also really important in a subtle and technical way beyond the obvious comparison of, oh hey, high grade gold, you know. Something that gets the smart audience and the dumb audience excited and everything in between. So, surprise, surprise, the best case is really obvious. But, you know, that's what I try and settle on, at least. And again, it's not my default expectation. So coming back to what's a more normal expectation for this January work program that they did, and how to put some bounds on what does a good program look like, what does a bad program look like, is there anything that they could get that would be so bad that they'd give up at Fisher and Mac. You know, so far it seems like they're pretty determined. You hear them telling the stories about how they had to drill a few seasons before they found this. The Claude guys had to drill a few times before they found what turned into 1 million ounces. So, you know, glad to hear SSR saying that, because they can afford the drilling. And I just wonder, you know, not so much what would make them quit, or even what would make them keep going, because we're so far along at this point. They've spent so much money, it's kind of like, yeah, sure, fine, whatever, keep going. That's not the issue I'm concerned about. It's almost something like you hear them saying, oh, if you hadn't drilled a few times, you know, even after you got nothing, you would have missed 1 million ounces. Well, what about 10 million ounces? Or 5 million ounces? Or 2 million ounces? Right? Like, yes, getting another 1 million is important. I want to see them do that. But again, I want to talk about stuff that's twice as good, or 10 times as good. You know, is talking about 10 million ounces at Santoy useful at all, or is that just totally misguided and muddying the waters? Probably at the Mac zone, you know, it's not helpful to talk about 10 million ounces just at Mac, but 2 million ounces at Mac? And again, at what point do they say, hey, this is good enough for us to want to build a whole new mill down here, because we think that we can double production at the complex. We can keep Santoy going for another 10 years, and we can get this thing going in 3, and then we'll be going on 2 legs, and we want that because Canadian gold price is screaming higher, and Saskatchewan is a top 10 global jurisdiction for gold mining all of a sudden. Maybe. That's what I'm looking for. Alright, Peter Bell. Thanks. Bye.